Corporate governance refers to the system of rules, practices, structures, and processes through which organizations are directed, controlled, and held accountable in the interests of shareholders and wider stakeholders. It establishes the framework within which boards of directors exercise leadership, make strategic decisions, monitor organizational performance, and ensure accountability for the stewardship of corporate resources. Within the program, corporate governance extends beyond legal compliance to encompass ethical leadership, risk management, transparency, stakeholder engagement, and sustainable value creation. Effective governance ensures that organizational objectives are pursued responsibly while balancing financial performance with long-term economic, social, and environmental responsibilities. As global business environments become increasingly complex, corporate governance has evolved into a critical mechanism for maintaining investor confidence, reducing agency conflicts, and promoting organizational resilience. The foundation of corporate governance lies in the separation of ownership and control, whereby shareholders provide capital and own the organization while directors and executive management exercise operational authority on their behalf. This separation creates the well-known agency problem, as managers may pursue personal interests that conflict with the objectives of shareholders and other stakeholders. Corporate governance mechanisms therefore seek to align managerial behavior with organizational objectives through accountability structures, performance monitoring, incentive systems, independent oversight, and transparent reporting. Strong governance reduces agency costs by ensuring that decision-makers remain accountable for their stewardship of organizational resources and strategic decisions. A principal objective of corporate governance is to support long-term value creation through responsible leadership and effective strategic oversight. Boards of directors are responsible for establishing organizational purpose, approving strategic direction, overseeing executive management, monitoring performance, and ensuring that risks are appropriately identified and managed. Governance therefore extends beyond financial control to include strategic planning, organizational culture, innovation, sustainability, and stakeholder relationships. Modern governance frameworks encourage boards to adopt a forward-looking perspective that balances short-term financial performance with long-term competitiveness, resilience, and ethical responsibility. Corporate governance also promotes transparency and accountability, ensuring that stakeholders receive reliable information regarding organizational performance, financial position, governance practices, and strategic decision-making. Transparent reporting enhances investor confidence by reducing information asymmetry between management and shareholders while strengthening market discipline and organizational legitimacy. Accountability mechanisms such as board committees, independent non-executive directors, internal control systems, external audits, and integrated reporting ensure that managerial actions remain subject to independent scrutiny. Such governance structures improve decision quality and reduce the likelihood of financial mismanagement, fraud, or unethical behavior that could undermine organizational reputation and stakeholder trust. An equally important dimension of governance is risk management and internal control. Effective governance frameworks establish clear responsibilities for identifying, assessing, monitoring, and mitigating strategic, operational, financial, and compliance risks. Boards are expected to determine organizational risk appetite, oversee internal control systems, monitor emerging threats, and ensure that appropriate governance processes support strategic objectives. Enterprise risk management therefore becomes an integral element of governance rather than a separate operational function. Strong governance enables organizations to balance risk and opportunity while protecting assets, maintaining business continuity, and supporting sustainable strategic development. Contemporary corporate governance increasingly adopts a stakeholder-oriented perspective, recognizing that organizational success depends upon relationships with employees, customers, suppliers, regulators, communities, governments, and society as well as shareholders. Sustainable organizations create long-term value by balancing diverse stakeholder interests through responsible business practices, ethical leadership, environmental stewardship, and corporate social responsibility initiatives. This broader governance philosophy reflects growing expectations that organizations should contribute positively to economic development and societal well-being while maintaining commercial competitiveness and financial sustainability. The program presents corporate governance as an integrated framework encompassing definition, objectives, key governance concepts, agency theory, purpose, and stakeholder relationships, demonstrating that governance extends across all organizational activities rather than existing solely as a regulatory requirement. Governance influences strategic direction, organizational culture, internal controls, ethical behavior, performance measurement, and reporting systems, thereby supporting effective leadership and sustainable competitive advantage. Corporate governance should be viewed as a strategic capability that enhances organizational resilience, legitimacy, and long-term performance. Strong governance supports better strategic decision-making by promoting independent oversight, constructive challenge, ethical judgment, and evidence-based evaluation while reducing the risk of managerial opportunism and strategic failure. Increasing emphasis on environmental, social, and governance (ESG) principles has further expanded the role of governance by integrating sustainability considerations into strategic planning and corporate accountability.